When money's not in motion, the economy is not healthy. So if we raise taxes and everybody's paying more taxes, two things happen. Either I spend down my assets or I reduce my expenditures, and there's less money in motion. If there's less money in motion, basic economics say the economy should slow down.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
This is John Smallwood, and today we're going to have some fun. We're going to talk about a topic that most of us really hate the impact of this on our wealth. And most of the time we only see it in April when we're either getting a tax refund or we're writing a check. You write your estimates, you write your stuff, but taxes are the single biggest destructor of wealth, okay? And what you're hearing right now in the media and the news is the 2025 sunset of the Tax Cuts and Jobs Act of 2017. We all thought when the election a few years ago took place that would get overturned. And there was a whole bunch of agita, tax code, tax laws, all kinds of things coming out of us that were pretty frightening. And it didn't happen. But one of the things that people don't really understand, and what I see happening, is they're talking about what is changing. And people have become a little bit complacent, and it's not going to happen. But the way the tax law was set up in 2017 is that it automatically sunsets, which means it goes away. It reverts back to the pre-2017 tax law, which would be the 2016 tax law. And what we're hearing is that top bracket will go from 37% to 39.6%. The exemption will go from 30,000 down to another number. The SALT deduction, state and local income tax deduction, will be restored. That's why people left high tax states, because they're living in New Jersey or New York or other places, California, that have high taxes, and they weren't able to deduct their state level taxes on their tax returns. And in one of the previous podcasts, we were talking about a couple different ways from a business owner to get that deduction, and that was isolated. But I think what's really interesting is most financial decisions are made from opinions, biases, and hearsay. We're not really talking about the impact on the wealth plan. We're just getting this fear and this sensation like, oh, tax rates are going up, so you should do certain things. Tax rates are going down, you should do things. And I just want to talk about this for a second. And if we make decisions based on opinions, hearsay, and biases, are we making the best decisions for ourselves? And do we have full transparency and full knowledge into what's currently happening? And when it shifts, what will be the impact? And I'm going to tell you, some of it's going to be really bad. Some of it's going to be neutral. Some of it's going to hurt people that you wouldn't expect that it's going to hurt, based upon things that I've been looking at over the last 3 to 5 years. And that 3 to 5 year time frame has been interesting, because what I've learned during that time frame is people have an opinion, and when you present new information to them, they have such hatred towards something that they don't look at the facts. And they believe that this or this party, and this is not a political thing. I do not want to be political, because it doesn't matter if the election goes one way or the other. It's the House and the Senate that are going to make this thing happen. The powers that be would have to overturn the sunsetting of the tax law in 2026. 25 is the last year that it happens. But this SALT deduction, state, local taxes, So New Jersey, New York, California, high tax states, Chicago, those taxes are no longer deductible on your personal tax return. They're limited. Well, they are, but they're limited to $10,000. So if you live in a place where you pay $50,000 in New Jersey taxes, you pay $20,000 in real estate taxes, so that's $70,000, you're only getting a deduction for $10,000. That's the state and local income tax, right? But what I found, and here's what I want you to understand is, because I'm potentially one way or the other way from a political standpoint, I can't see the facts. And that's the danger that I see all the time, right? So I'm making decisions that I think my taxes are going to go down when the state and local income tax deductions get restored. And that's kind of funny to me. What evidence have you looked at that actually supports your thesis? Or is it just opinions, bias, and hearsay? And I'm going to go off on that for a couple of seconds because I just celebrated. I didn't really celebrate it. Actually, I have to really celebrate it. 34 years of being in the financial services business in May 1990. I actually entered the financial services in the summer of '89 as I got licensed for life and health insurance. And I did some payroll deduction and I sold some disability and life insurance back in the day in '89. So it's actually 35 years right now. But the official 1990, May 1990, graduate college, jump into the business is there. The 35 years, tax laws have come and gone. They've changed. Opinions and biases and hearsay continue to perpetuate the way people make decisions. And when we make financial decisions based on opinions, hearsay, and biases, I think we make some really bad decisions. And I was thinking about this as I was prepping for today's conversation. And I thought it would be really helpful, rather than going through the list and saying the top bracket's going to go from 37% at $693,000, married filing joint, to 39.6 over 600. If you're married filing joint and you make between $89,000 and $90,000 and $190,000, that $100,000 spread there, currently you're in a 22% bracket. You will, at 165, you'll hit the 24% bracket. But what does that mean? Okay. Is it important to you? Capital gain rates, top capital gain rate, single taxpayer. Anything over $492,000 of adjusted gross income is taxed at 20%. Now it'll be $441,000, $50,000. Doesn't seem like a big deal. And then you're going to have I'm using my cheat sheet because there's a whole bunch of stuff here that is changing on a daily basis. The deduction will go back to the tax law, the pre-2017 tax law. The personal exemption will be reinstated. Full SALT deduction will come back. Mortgage interest deduction will go from capped at $750,000 on a mortgage back up to the $1 million, the way it was. Reduced child credit from $2,000 to $1,000. Probably doesn't matter if you're listening to the podcast, that child credit. I'm just joking. And the lower estate tax and gift tax from a little bit over $13 million back down to about $5.5 million per person. And that's the noise that you sort of hear. And there's this complacency, like it'll get overturned. The estate tax law won't go down from, let's say, husband and wife combined, 26 million down to 10 million. It's not going to happen. And what I'm going to tell you is if you wait you'll be very reactive. If you look at the plan and say, what can I install in my financial strategies today that works really well with the current tax law, and I have these other bells and whistles in my plan to increase my deductions, to increase my deferral, to move money, to reduce income that shows up on my tax return, to get more strategic with that, I will be really well prepared if the tax law sunsets. I'm not saying it's going to sunset, but if whoever gets elected, it's automatically happening unless that collective organization gets together and comes up with something new. We've heard the 45% capital gain rate from President Biden. We've heard, Donald Trump out there talking about, corporate tax lowering and all these things lowering. Is that for election purposes or is that for reality, right? We've heard the exemption amount will go from 14 million to 13.5 million down to 5.5 to 6 million, depending on what publication that you're reading. And everybody's like, it'll probably stay. The impact of increased ordinary income tax rates. One of the proposals that I've been hearing, and this was after the last election, was rather than having 600 and 1,000 and above get taxed at 39.6, let's move that back to 400 married filing joint and tax everybody at the 39.6 that's higher. Is that fear? I don't know. So what I thought would be really helpful is to talk about and visually show, which if you're listening to this on a podcast medium over on the YouTube channel, there'll be a video. You can actually go through what I'm going to be showing. Is I created basically 3 avatars. I did a husband and wife who are retired, financially successful, who has, you can either have it with a pension or not. They're taking Social Security, IRA withdrawals, and some portfolio withdrawals. And then we're going to simulate that through the changing of this, sunsetting into 2026 and see what the impact is. Then I have what I call big W-2, which we're going to play around with the W-2 impact. And then we have a business owner. So I'm going to go through them in a way that it's going to be fast. But I think what's really, really important is if my variables are the same and the only thing I change is the tax law, I want to understand what financial pressure is being presented on my plan. Because everything has an opposite and equal reaction. If one thing happens here, something else is happening over here. And that's either going to be a good or bad strategy. Okay? So let me go through. I'm going to go through this in a sequential manner, right? I'm going to go through the retired people first, because this is where, over the last 3-4 years, people seem to be waiting and thinking that they're going to be in a lower tax bracket when it comes to the situation. So I have basically we have 2 people, 74. So they're beyond the required minimum distribution age. And what we have, just to make this really simplistic, is we have this, there's dividends being brought onto their portfolios. There's Social Security that's $70,000 combined. They're paying tax on 60. They've got a IRA distribution of $43,000, which is the required minimum distribution. So this may look like you, and they pay about $11,000 in federal income taxes. So when you look at it, they got about $137,000 worth of income. Now, if I put a pension in there, it'll bump it up. Not a lot of people have pensions, or it's not a huge portion of their income, okay? So what I want to look at is if I simulate the retirement, you could see, hey, there's got a 90%, 97% probability of success, and I think some of that is not that smart, okay? But I want to talk about this from a standpoint of, when you look at this, let's go back one for a second. We'll go back to the details. We'll look at so we're looking at the 1040 here. Now I'm going to go to the Schedule A, which is where the deductions are. So this is the situation where we see real estate taxes and other state and local income taxes at a combination of $29,500, right? So, but they're only getting the 10,000 and they're good. They have their mortgage paid for. They're living a really good, this is really, really good. Okay. So I run this simulation. I run the cash flows, and I want to just jump in here for a second and say the income flows are Social Security and the dividends and interest off their portfolio. They're living a very, well-structured plan here. They're getting their IRA required minimum distribution you're seeing with basic assumptions. That is increasing every single year, despite potentially the balance heading down. And I have them going out to 90. Typically, we do a plan to, age 80. And I've said, okay, here's your living expenses. Your house, real estate taxes. In New Jersey, real estate taxes are high, so I just put in $19,000. And you've got insurance, maintenance around the house. So the house cost you $24,000. Wonderful. You've got your Medicare supplement here for another $10,000 combined. I just want you to understand this. I'm going to go through this here. And so they're bringing in $142,000. They've got $142,000 of expenses. So it's sort of like, like it's really, really tight, right? But then, they have $11,000 worth of taxes. And when you dig into this, you see the deductions, but they only have to pull out another $1,000 a month or $12,000 from their portfolio. So when you look at the math, right, and you look at the net worth, things are moving. The portfolio is increasing, assuming a levelized return, no market volatility here. You guys know I love market volatility. But this is really, really, really interesting, right? So, but I want you to focus in here for a second. So as I go through this, in 2025, taxes jumped up a little bit because you have a little bit of inflation on the Social Security, et cetera, hopefully. And the taxes jump in 2025 to 2026. You're going to notice it's up $4,000 in income, but the taxes are up $4,000. We went from $11,547 to $15,000 in tax. Intuitively, I would have thought the restoration of the SALT deduction would have kept this better. So what you see here is when you look at 2026, they were getting a deduction for $32,000, $33,000. Taxable income was $107,000. Now they go to this $20,000 deduction and they get that personal exemption of $8,700, but their taxable income is now $115,000, and they're hitting those brackets at a faster rate. So the taxes are up 40%, right? That's close to 40% from $11,000 to $15,000. These people are retired making $137,000, and the majority of their income is coming from Social Security. That's not what people think was going to happen from most people that I talk to, okay, that come in. Now, if I jump out for a second and we look at this, the consequence. So we talk about financial pressure, right? Financial pressure is either positive or negative. It's impacting your wealth potential by increasing wealth or eroding wealth. So when I erode wealth, that means I've increased the pressure. So if my taxes went up and I've got inflation, because what's happening in everybody's world is everything costs more all over the place. So we've had this getting out of the grocery store, my real estate taxes, my insurance costs. I mean, can't tell me how many people moved to Florida thinking their property insurance is going to be $4,000 and now it's $14,000. Like that is a ripple effect. Like they lost all the benefit of tax reduction of leaving New Jersey because now the real estate taxes, not the real estate taxes, their homeowners insurance went through the roof. But if you think about it for a second, just visualize with me for a second, think with me. One of my great professors of economics at Bentley College back in the day, Marshall Gennaro, who can't be here at this point in time, 30-something years later, 35 years later, he used to say, think with me. And it was a really cool thing. Like, don't just think with me for a second, run through the strategy. That thing, when I got into that class, it was a macroeconomic class. It changed my whole thinking because I was able to think through big picture with him. But if I've got all this financial pressure, I have my own personal inflation rate. So my real estate taxes went up, my homeowner's insurance went up, my groceries went up, my car costs went up, everything went up in my strategy. And now we're going to get this sunset, which is going to increase. These expenses may actually be higher than I'm projecting. But these expenses have now, in order for me to meet my cash flow goals and wants and dreams, which is why I retired, because I want to live a beautiful, fulfilling life, my taxes have gone up from 11.5 to 15.5, and my net withdrawal has gone from 11.6 to 14.8. It's another $3,000. So I've increased the withdrawal rate on my portfolio. One of the things I did in one of the previous podcasts is if the withdrawal rate gets over a certain percentage and you have down market volatility, the odds of running out of money go up exponentially. So what's happening here is if the tax law sunsets, or when the tax law sunsets, or something else comes out, how will you be impacted and how will you defend against it today? What are some of the strategies that you can use to reduce some of your taxable income? And I see a lot of things out here that are not smart. It's like put all your money in one basket, put it all in one product, and that's going to get you to zero tax. And I've got some issues with that because anytime I do something that's singular in wealth management, meaning the miracle product will save your life, it's wrong. Okay? It has to be in a harmonious balance. You cannot have a successful plan with only one product. You have to have multiple products that come together in a unique blended way for your unique circumstances, because your circumstances are different than mine. They're different than your neighbors, are different than your brothers or your sisters or your best friends. They are unique to you. And how you design your financial strategies is different than your neighbor. Okay? And that's the opinions and the biases and the hearsay. My brother-in-law said I should do this. And he's successful. Do you know if he's successful? And is he successful? Is he enjoying his wealth? Because to me, financial success is a blend of accumulating as much money as I can, enjoying as much money as I can, and passing as much money to my family as I possibly can. You know, I'm spending my last dollar bumper sticker is not what I want on my back of my car, right? Like that is shit. Okay. I'm just going to basically put that out there. I don't like that. So there are certain things out there. It's kind of like the term go big or go home. How about just go bigger? Why do I have to go home? The takeaway on this, modest income, Social Security, IRA distribution that happens to be really a good basis here, and dividends and interest coming off the portfolio, and you're enjoying them, you're actually getting subject to higher taxes. Did you think that was going to happen? Most people don't. So how do I prepare? There's a thing called alternative minimum tax, better known as AMT. Remember, everybody was an AMT prior to the 2017 tax law, which means IRS says this is the minimum amount of taxes that you have to pay. And if I look at this, and you look at the schedule, because in the software, in the simulation strategy here, we have all the schedules. And the alternative minimum tax says, you're paying 11, but you could pay, if I'm looking at this the right way, you could pay about $3,900. How could you get it down to $3,900? That's interesting. It's a lot of money. Okay. So focus on AMT, and people's impact on AMT is going to become extremely important as we go forward. Mortgage interest deductions will become more valuable in the next tax law. if they sunset. Deferral might become more powerful because you have to, I don't love deferral for a lot of people because there's this mindset that basically says I'm going to defer from the current tax bracket that I'm in to a lower tax bracket. The sole purpose of tax deferral, deferred comp, 401k, etc., is to take money from the current bracket and defer it to a future when I'm going to be in a lower tax bracket. If I'm going to be successful, I may or may not be in a lower tax bracket. But a lot of people are coming in, they haven't accumulated enough money, and they are going to be in a lower tax bracket. And when you start to look at these things, you could see when you look at the distributions and you look at the effective bracket in this particular retiree is actually increasing. And if you look at it as the marginal bracket, it's actually increasing dramatically throughout their entire time frame. Where was I? What bracket was I in when I was deferring? If I was deferring at 30 and I pull out at 15, win-win. If I'm deferring at 30 effective and pulling out at 39.6, lose-lose. Makes sense, right? So everything that we do in the wealth management side is to think strategically. So what I did here is I went to what I'm going to call the big W-2, big W-2, okay? Somebody who works high-level corporate executive, work for a company, Wall Street person, every single dime that you get is in W-2. And you're all sitting here going, oh, this state level tax, state and local income taxes that I am paying that I'm not getting any tax benefits for is destroying me. I can't wait for this new tax law to sunset and get back to the old SALT deduction. So what we did here, just to give you a little context of this person has $2 million in an investment account. They've got a house and a mortgage at a house at 1.5 and a mortgage at 9.25. I'm trying to make this the smallest, least complex for the strategy. And they have a W-2 for $1.3 million. So really successful, right? And what I want to do is I'm going to run through the same scenario and then I'll flip it, I think, down to like $600,000 because I want you to see the $600,000 W-2 also because I think it's important. This is something that we see often in our practice, and it is something that there's a lot of things that can be done, but it's very difficult for a W-2 person to get a lot of really compelling, besides deferred comp, but how those deferred comps come out, what I'm finding is you're just getting taxed at a higher rate. So if I'm deferring today and the top bracket is 37 and the money's going to come out at 39 2 years from now when it sunsets, was that a good decision? Doesn't matter what you make because you're paying a higher tax on it. But a lot of people have to. So here's the same scenario. And what I did to keep this really easy is I said the salary will flatline at the 1.3 million. So there's no inflation, just to make it simple. The investment income's going up because of the simulation of the 6.5% return that's in the strategy. They have, the house basically with the mortgage interest and real estate taxes of $25,000 is costing them principal, interest, real estate taxes, and homeowners insurance is costing about $80,000 per year. And healthcare is paid by the company or it's deducted from their paycheck. So I'm not getting really that. And they're 49 years old. So they're deferring and then they're going to increase their deferral to 31,000 when they hit 50. Okay. So this is where I wanted to take a look at this. And I want you to view this. I'm zooming in on this now on the YouTube side, where we have this tax payment that's running $533,000. And when you dig into it, the New Jersey tax in this particular case is $100,000. The FICA is $38,000, Medicare and FICA. The federal taxes are $394,000. And I'm going to switch back over for a second to the tax form, because I want you to see it in a couple different manners, right? This is one of those charts. If you're looking at this person is in the 40% 29.9% federal effective tax bracket. When you look at where they are, they're in the 37 right now, going to the 39.6 when the tax law sunsets. But the effective bracket is, when you take in federal at 29, state at 7.6, FICA at 2.9, they're in this top bracket for a long time. But I want you to focus on this, is that you see taxable income of $1,276,000, taxes of $392,000. And you look at the Schedule A, which is basically there's $135,000 worth of SALT that you're only getting $10,000 of deduction. If I fast forward this to 2026, that 125 and the 36 is now 100. It's 150, 100 and almost 160 but now we have that phase out of those itemized deductions that come back. So now I'm only able to get 132 of that almost 160 of deduction. And when I look at it on the federal side, when I go back to the 1040, the taxes are 397. So what I see here is I do not see relief. I do not see, because when you look at the tax planning, and if I just zoom in on the federal tax side, you're taking the standard deduction now of $40,000 and you're pissed about it. Last I checked, okay? Now you get your standard deduction of $132,000, but you paid on $160 in exemptions. My taxable income pre-sunset is $1,283,000. Now it's $1,209,000 with the deductions. But my taxable income drops by almost $80,000, 70 and change, and my tax goes up $6,000. Where's the benefit of the SALT? Please pass the SALT. If I look at it on this person, back to the cash flows, I actually look at it and their net cash flows went from $409,000 down to $405 in my simulation of this big W-2 person. That's not a big impact at all. If I drop this W-2, hopefully that mortgage payment still works when I do this. We drop it down to $600,000. Let's just look at $600,000 really quick, right? Because I think this is going to be an interesting conversation. We do the 600, we run the retirement simulation. Now the probability is going to drop. It was 97 and now it's 40. This happens, right? That's why putting money aside and investing and saving and growing wealth as soon as you possibly can becomes the most important part of this. But in that $600,000 level, big picture, taxes, I'm now putting my 401k has increased because I'm 50 to 31 from 23, deferral. My net after-tax cash flows were 45. The following year, my tax payment jumps from 189 to 213. My savings gets destroyed. And it actually runs negative if I'm flatlining at the 600,000. And I want to just jump in here to the tax payment just to show you this in this thing. I know this is small, but what I'm really passionate about is opinions, biases, and hearsay. No, I'm joking about that, right? What I'm really passionate about is taking opinions, biases, and hearsay and saying, let's apply fact to it. Now, is it factual that the tax law is going to sunset? Maybe. I don't know. But if it does, is it factual the way we're displaying it? Or is it my opinion, biases, or hearsay? And my question is, if my deduction went from 40K to 85K, and my taxable income went from 576 down to 540, intuitively, I should be paying less tax. But my tax is jumping up by $6,000 federally. That person is actually getting paid, is getting not paid, but getting a bigger consequence from this tax law. That's not intuitive. And if I drop it down into the 400 range, because you're hitting brackets faster, sooner, quicker, you actually get penalized worse. And what I'm hoping is I get a lot of really interesting feedback on this. I'm hoping that this causes you to make a plan. You need to talk to your people to figure out, how do I get down to that AMT number? How do I prep today so that when that tax law rips through and it happens, I'm prepared for it? If it doesn't happen, I made really good decisions that will benefit from me in the current tax law, but will also work in the next tax law. And maybe I've got 40 other things that we can be focused on that could help it in the plan. What strategic action? Maybe it's not 40, maybe it's 10, maybe it's 3. There's no guarantees of what we can do. But the idea is you got to understand the impact. Now, business owners is the next one that I want to jump into. If you're still listening, thank you, because this is a very technical thing, but I think it's really, really important. And this is information that I don't think is out there, and I don't think people are really understanding it. And like most business owners, you're a one-arm paper hanger. You're doing everything. You might be running payroll. You might be running over here, and then you're going to go over here. And like, you don't have time to focus. And when you go to your accountant, he says, you owe blank. And then you see him next year and you owe blank. There's no tax planning that's going on in between. Tax planning is incredibly important in every aspect of your strategy. Now, as a business owner, you have, depending on the business that you have, you potentially qualify for qualified business income deduction. Do you know if you have qualified business income deduction now? And are you getting the right amount? If you're self-employed, pass-through entity, S Corp, LLC, blah, 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 right? All those wonderful tax entities that we've discussed, is I get to deduct 20% of that earnings. So let's say I make $1 million. If I make $1 million, I can take 20% off the top under the qualified business income deduction if I'm in one of the right businesses. If I'm in a service business, I can't do it. I'm limited to about 400,000 of it. Attorneys, engineers, registered investment advisory firms, they are limited at certain levels. Or that 20% deduction is 50% of your W-2 wage base that you pay out in the firm. So if I only pay out, $200,000 worth of wages, I'm only going to be able to deduct 100 of that. So I don't get the full 200. So planning is extremely important. Now, in the business owner side, and I didn't do this in this calculation, is many states, like 35 states, have what's called a pass-through entity tax that allows the business owner to pay his or her state-level taxes at the corporate level and take a deduction at the corporate level. In New Jersey, it's called BAIT, B-A-I-T. It currently does not have a sunset on it. The legislation at the time has to get together and say, do we still need the BAIT tax? Because people are leaving. What they like about BAIT tax is they get their taxes sooner, because everybody, instead of paying, self-employed guys paying big checks in April, they pay it before because they got to get that deduction. You had to do that under the old tax law too, but it's even better now because it's a ripple effect, right? If I have $100,000 of New Jersey tax to pay and I have an S Corp that has a profit of $1 million, I've now reduced my taxable income to $900 by making that payment. And then I get qualified business income deduction so that's like $280,000 worth of deductions. It's $280,000 of tax-free money. What are you doing with that tax-free money that keeps it tax-free in the future? Huh? It's $280,000 of it's like deferred comp that's tax-free. Are we putting it into something that's going to just create more taxes, or are we being smart and limiting the taxes that I'm going to pay? So here's my profile. Business owner, business, 44-year-old, pays himself, him and his wife both work in the business. They pay base salaries of $350 and $150, which I question whether or not that's right. We'll have a whole other conversation about this. And they own a business. They have investments of $2 million. They have a house worth 1.8, and their business, their S corp, is valuation of $4 million, and they pay another $650,000 out in S corporation distributions. There's so many things wrong with the way that's happening right now in my example, but this is what I see when people walk in the front door. When they walk out the back door, we kind of design it a little bit differently, okay? But I want you to look at the tax return. And this is sort of what your tax return looks like. There's the salaries. There was deferrals into the 401ks. There is some other income coming in of 8 of the 650,000. So you're seeing total income of $1,150,000 less the standard deduction of $32,000. Then you see line 13, qualified business income deduction, $130,000. It's close to the 20% of the 650. It is. Okay. And they pay $285,000 in federal income taxes. And if you look at their Schedule A, I'm actually not making the bait payment in this particular strategy. But they're paying $83,000 in New Jersey taxes, plus $22,000 in property taxes, and only able to deduct $10K. And they have $22,000 of mortgage interest, non-deductible, right? All good. Happy, living life, enjoying, going to sell that business someday. It's all going to be good. And it is, because that's what we're going to help orchestrate here. So what I wanted to show you is we're flatlining the salaries at $500,000. The business income is flatlining at $650,000. They are investing their extra proceeds, so the dividends and the capital gains are increasing through the strategy here. And they're spending basically $25,000 per month, $317,000. There's $412,000 left over at the end of the year, which is either getting reinvested back in the business strategically to grow that business, or getting reinvested in another portfolio. In this model, it's getting invested in the portfolio. My question is, where's the best return on your money? Is it in the business, or is it outside the business? Do you have a mature business, or do you have a hyper growth business? But at some point, you need to start pulling money out of the business to stockpile it, because too many people put all their money in their business, think they're going to sell it, and then they don't sell it for what they think they're going to sell it for, and then they F themselves. So we want to un-F ourselves, okay? But I want you to focus on, here's the big thing. Federal taxes in 2025, and I think they could be lower if we maximize everything that I just said, was $287,000 in this model. The very next year, it goes to $342,000. Almost $60,000 difference. That's a painful impact on the business owner. And the business owner, fastest growing thing out there. How many people became business owners during the pandemic, right? Stay at home, work from home, independent contractor, grow a business, do a franchise, get downsized. I'm going to go into this business. So when you think about this, you see this, and the quality of this is they were getting $130,000 worth of qualified business income deduction, and their taxable income was $984,990. In the following year, when I get this beautiful restoration of the SALT deduction, my taxable income is only $1,050,000. It's only $60,000 more. of taxable income, but my taxes went from 285 to 340. It's like kind of ridiculous. And everybody's listening to this. Business owners, those business owners, they deserve it. I don't know. What's the velocity of money and the money multiplier effect? Back to Marshall. Money in motion in the economy, the more money is in motion, less money in the hands of the government, less money in hands of sitting in stagnant, the sub-H block in economics, right? When money's not in motion, the economy is not healthy. So if we raise taxes and everybody's paying more taxes, two things happen. Either I spend down my assets or I reduce my expenditures. And there's less money in motion. If there's less money in motion, basic economics say the economy should slow down. But I want to look at this from an impact. This person had net cash flows of $416. Now they have net cash flows of $365. $60,000 less cash flows. If that money's getting reinvested back in the business, it's less money getting reinvested back in the business. It's less money getting invested in the portfolio. It's less money that's maybe going out in the form of consumption that I'm not showing for lifestyle. And this is where financial pressure really heats itself up. And business owners that are in the $400,000 range actually get walloped even harder like the W-2 people. So the takeaway on what I'm trying to, what the mindset that I'm trying to get you through here in this conversation is, if or when or if we get a new tax law, have you taken the right steps to prepare yourself for that incoming thing that's going to happen? But I'm going to pose a different question. Have you even maximized the current tax law? Have you really dug in and said, am I taking advantage of every tax law? Have I strategically said, am I knocking money down and paying the least amount of taxes that I possibly can right now, whether I'm retired, whether I'm W-2, or I am business owner? And in my 35 years, 34, 35, pick one. 34 if I look at the official from 1990. Most people pay more taxes than they should. If I pay more taxes than I should, I have now what's called opportunity cost. If I'm the retiree and I'm forced to increase my withdrawal rate to a higher rate just to meet my cash flows, now my risk of spending that money has gone up exponentially. So the question is, what have you done this year to make sure that this year you're paying the least amount of taxes? If you don't master this tax law, I doubt you'll master the next tax law. And if I have 5 to 10 years of paying more taxes than I should, that's a massive opportunity cost. As a business owner, you have the business and your personal plan. You have many more opportunities for having fun with tax law. And I'm not saying, let's be really clear here. There are things that are going to get you in trouble, and there's things that are not going to get you in trouble. They're in the tax law. Are you using them to your strategic opportunities? If mortgage interest becomes a very valuable deduction, is it better for me to have that mortgage or not have that mortgage from a tax perspective? And people are like, oh, debt's bad, interest rates are high. But if you think about it, 3 years ago, when the interest rates in the economy for a mortgage were like 2.75, how much was your money making in the bank? 0.5, if you were lucky. The spread was 2.4 to 2.7. Now your money's making 5 and interest rates are 7. It's still 2. It's still a 2% spread. And if you were smart enough to keep cash a few years ago and put less money down on your house, the money that was making 2 point nothing or nothing is now making 5. And you're paying 2.75 in a mortgage. Smart. And I'm not saying to go into debt. I'm not saying to do things. What I'm saying is you need to be strategic and create the individual strategy and plan for yourself and not worry about what the other side of this is actually doing. Meaning, when I say not worry about the other side, is what is going to happen in 2026, we have no control over. When we get there, if we have the lens of making good strategic investments in strategies and in deploying good strategies that actually reduce taxes today, but the strategy itself doesn't compound the taxation, it actually has a tax reduction over time. Those are smart strategies in any environment. And what my knowledge basically tells me, or my timeline of success in this business, being here for 34, 35 years, is that everything's going to change. Nothing is going to be the same. The variables are not going to be the same. You can't predict the outcome. You cannot predict what will happen because you can't predict who's going to get elected. You can't predict, the full slate of all people being elected at all times, right? It's a massive opportunity here. But I want my takeaway today, money isn't just one thing. Money is the sum of all of your decisions. And the sum of all of those decisions properly coordinated will reduce taxes, will reduce risk, could reduce risk, could reduce taxes, could help increase your savings rate, could provide more benefits and more protection, could give you more retirement income, and could pass more to your family. Those are the things that I want to work on with everybody, and I want you to do the same thing. So I hope you enjoyed this. I hope, there's a lot of numbers. The best numbers are your own numbers. So when we dig in and we get your own numbers, and you simulate your own numbers and you simulate different outcomes, and you understand what are the things that I could be doing today to reduce these taxes, I think you'll be happier. I truly appreciate you listening. As with anything, if you found value in this, please share it, like it. If you found it to be something that you didn't like, share the feedback too. I'd love to hear it. I think this is really, really powerful, and feedback is the most important thing that anybody can get, because with good feedback comes great change. Have a wonderful day.